Hi, I'm Dawn Pullen, and I help owners of commercial real estate capture incentives that inject vital cash into their business today for a more profitable tomorrow. Today, we're going to start talking about 1031 exchanges. We're going to talk about what is a 1031 exchange and why does it have a funny name? Who can benefit from a 1031 exchange? And lastly, what is the long-term play for 1031 exchanges? So first, what is a 1031 exchange? Well, the reason why it has a funny name is the 1031 is referring to the tax code that allows it to happen. Just like 401k is the tax code that allows you to have a 401k. So for 1031s, what is it and why is it one of the favorite tax planning techniques of all real estate investors? What the exchange allows you to do is to literally exchange one building for another building, which you have to sell one building and then purchase another building and defer the tax, which means you pay no tax on that exchange. As you can imagine, there's a lot of rules around that. First, your property has to be held for investment purposes, which means you are managing that, renting that, making money from that. It cannot be a primary residence. It cannot be a second home, something that's just sitting, you're not using it. It needs to be something that you are actually generating or trying to generate income from as an investment, or you're actively managing it. So if you're actively managing like a shopping plaza, it may not feel like passive income, but it is more considered a passive investment in the eyes of the IRS. So you are allowed to sell, for example, that shopping plaza. Let's say you purchased it for $1 million and now it's worth $3 million. You can sell it for $3 million and you can buy another piece of property. It can be land, it can just be land, or it can be another building and land for $3 million. Without paying any tax on that exchange. That $2 million is tax-free. What if you purchased a building that was $4 million? So you had $3 million from your old property and you had to put in another $1 million. That is also going to be, that transfer is going to be tax deferred. That's fine because you bought something of equal or higher value. What if you bought a building that was only worth $2 million, so you had $1 million left over that you want to put in the bank? You can't do that. So you can do that, but that's going to create what's called boot, which means a portion of that transfer is going to be taxable. In a nutshell, that's how it works. So if you buy a property with an equal or a higher value, the entire sale from the original property will not be taxed. That's the gain portion, and that does count for federal and state. So for our third question, what is the long-term play for 1031s? So let's say you exchange that property, you get a new property, 5-10 years later, you exchange that property for yet another new property. If you continue to do that throughout your lifetime, you can do it on many buildings. This is called the swap till you drop concept. Dropping means you die. So if you hold that property throughout your entire lifetime, and then you pass away and your property is now inherited by your heirs and it goes to your estate, they can get what's called a step up in basis. So let's say the last property you owned, you had a basis in it now of 0. You've probably fully depreciated it and they sell it for $10 million. As long as you're still under your exemption for your estate, and that's a whole nother kit and caboodle with tax law, then they can now have a basis in that of $10 million, which you never had to pay tax on, and they don't either. If they turn around and sell that property the next day for $10 million, it all counts as basis and none of that gets taxed. So that is the swap till you drop concept. That's the long-term play for 1031s that everybody is thinking about. I will say, it just depends on what the laws are, the tax laws in the year that you die. That will dictate how far that will go and how that will work. So in a nutshell, that is what 1031 exchange is. That's how it can benefit real estate investors. Please continue to watch our next videos. We're going to talk about the interplay between a 1031 exchange and cost segregation. You can start to layer these benefits together. So join us in our next video. Remember, tax cash today is worth more than cash tomorrow. Let me help you today.